Very good evening, ladies and gentlemen. This is Rahul Magan, and today I would be covering a very important topic. And I'm shooting this video on 25th October, and I'm sure the kind of busy schedule I'm holding, it won't be possible to have this video live before 20th of November. Ladies and gentlemen, we all know that what is happening in the Indian financial market. Almost every possible day, both Nifty and Sensex is falling. And the fall is not 50, 60 point, fall is very, very dramatic. But I'm not talking about that fall in this video. I'm talking about something which is definitely a concern for international investors, and that concern is the dollar pricing. We all know that effective 2022, in fact 2021, Federal Reserve led with many other central banks start hiking the rate. They are holding opinion that if they would be hiking the rate, then they would be able to tame the inflation. But it's quite unfortunate that even after substantial rate hike, the inflation is still intact. God forbid if the Israel and Hamas issue would continue for another 1 or 2 months, then God is the only saver. I don't have any words pertaining to that. Federal Reserve not yet openly said that there is a stop on the rate hike, which means no more rate hike to happen in the near future. But saying or no saying, the 10-year treasury yield is almost more than 5%. Ladies and gentlemen, like in the earlier videos also, I explained you that every country in the world have two curves. Number one, the OIS curve. OIS means overnight index swap curve. OIS curve is generally useful curve when it comes to the interest rate in the call money market of that country. Basically the interbank of that country, simplistically speaking. While the benchmark curve, like US also having a benchmark curve, and they are holding the deepest benchmark curve in the world. The benchmark curve is used to price or reprice the securities which the government would like to sell. Of course, the primary dealers come into the picture. It is always said that if the benchmark curve of the relevant country is strong, rather deep, in this eventuality, the government will get the best offer. And when government get the best offer, it means that the interest burden on the government is always less. But that is quite unfortunate that nothing much spoke about as far as the benchmark curve is concerned. As we speak, the world having 20 plus benchmark curves like US dollar, GBP, Euro, Swiss franc, Canadian dollar, Australian dollar, Indian rupee, tick, 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 we have 64 benchmark curves. Ladies and gentlemen, the 10-year treasury yield is almost 5%. And this is definitely a bad news for the emerging economy. So let's make a hypothetical example about an Indian entity, Ramlal Chole Bhature. I once again repeat, this is a hypothetical example. God forbid if that story which I'm making to make the video more concrete, if that story, coincidentally ends up being a similar story, then it's a pure coincidence. So Ramlal Chole Bhature is a very big brand, let's assume, and they have their shops across India. Mumbai, Delhi, Calcutta, Madras, Gurugram, and all Bangalore and all different states. It means they need a huge money. So assuming they borrowed $1 billion from any XYZ bank of US, many people in the world do not know how to hedge US dollar. What is dollarization swap? what is reverse dollarization swap? Should we go with dollarization swap? Should we go with reverse dollarization swaps? Should we hold on? Should we hedge it for a shorter period and keep the longer period open? Should we hedge it like a like a bullet, which means the whole, or should we hedge it like a ladder, which means step by step by step by step as it would come, we would continue to hedge this. Now dollar rate is going up because of the Federal Reserve. The 10-year benchmark yield curve crossed 5%, which practically means that the OIS curve, overnight index swap curve, is also high. It's a common sense, which practically means that the POS curve, principal only swap curve, is also high. Because what is POS? POS means when you are converting a dollar asset into INR asset, or you are converting a dollar liability into INR liability. People always feel that, POS curve, POS means principal only swap. POS curve is always there for the liability part. No, ladies and gentlemen, POS curve having bid, which means asset, having ask, which means liability. It's up to your reputation. Sometimes people get mid also. So that's completely your reputation. I don't think many people even understand what is POS mid, how to get a POS mid, and how once you get POS mid, you would be able to save a substantial money in terms of hedging cost for your company. Anyways, now interest rate is going up in US, which means the COS component, coupon only swap, the floating component, which that company Ramlal Chole Bhature hypothetically assumed supposed to pay to the US party, this would definitely grow. Now, once this grow, it would have two double-edged impact on the balance, on the PNL of Ramlal Chole Bhature. Number one, in fact, three-side impact. Number one, they need to pay more interest rate because they may borrowed it at 2.5% or probably 3%, but since it's a floating structure, now it is 5%, you need to pay higher. It's a common sense. It means the more outgo from your pocket. More outgo from your pocket, it means is hurting your PNL. But you can't stop that outgo because of the rate hike by the central bank. There is an increase in the benchmark and OIS curve. The second issue is that you are a company, hypothetically assumed Ramlal Chole Bhature, you are principally Indian company, which means that the principal currency of the company is Indian rupee. And like we assumed hypothetically, the operations you are having in India, which means like whatever FMCG products you are selling, XYZ, the revenue which you are making is in India because the cost is in India. Your employees is in India, your electricity, furniture, fixtures, facility, and all these cost is in Indian rupee. Henceforth, you need to purchase dollars at a higher rate to pay the dollar pricing to the foreign bank, which means there is another hit in your PNL. So I repeat, number one hit is definitely the hit of the higher interest rate. You're supposed to pay the higher interest rate. And number two hit is definitely the higher Indian rupee you're supposed to pay. Third hit is your revaluation hit. Because every time when you close your books, probably month end, quarter end, or the year end, in this eventuality, you would have more INR liabilities as compared to the earlier one because interest rate is going up, Indian rupee is depreciating. It means more INR liability as compared to last year period, which technically is known as revaluation. Now, because of that revaluation, the impact of that revaluation is hitting your PNL. It means it is hitting your bottom line, which is called PAT, profit after tax. Many corporates I've been through, I continue to see the annual reports of the companies which are on their website and try and see how many of them are having a fair value hedging program. But I fail to understand many of them do not have appropriate or any kind of fair value hedging program. In this eventuality, your PNL is swung like this: one day plus, another quarter minus, another quarter plus, third quarter minus, and there is no surety that Federal Reserve is done. There is no surety. Maybe the next meeting, Federal Reserve say, no, I'm not done. I'm going with one more rate hike because I think that inflation is high and that rate hike is fairly possible. Ladies and gentlemen, dollar volatility always hold a negative as well as positive impact for EM, emerging markets. Reason behind emerging market are price taker, they are not price maker. And since the functional currency of the emerging market is altogether different and definitely not the US dollar, henceforth the impact of revaluation is coming into the picture. There is hardly any doubt about that. It is always pertinent to have a full and fledged hedging program in place, especially in these volatile times. We really do not know what is going to be happen probably 6 months down the line. Like today, when I was doing my research on the internet, I saw many scary articles about the glaciers which are melting in the Antarctica. Many scary articles. I read few of them line by line, and unfortunately, the information which is provided in these articles is very scary. It means we are heading towards a big geopolitical issue, geological issue. Amazon River, which is considered as a lifeline of Amazon, one of the longest as well as one of the, I would say, having a deep and denting history in the humanity, in the mankind. Now this river is almost dried. We do not know what to happen in the Ukraine war. We do not know what to happen in Hamas war. We do not know, God forbid, tomorrow any other country XYZ would default. We do not know any big bank in XYZ country get bust. Henceforth, the emerging market players, it is always important to hedge your exposure. I know that the counter argument is always that what would if I hedge myself now at 5% and after a year or so, the rate will further fell to 2%, then I'm paying 3% extra. I completely take your opinion. But having said that, when you was taking the loan in your initial stages, had you hedged your exposure, today the impact of dollar volatility, which is very much prevalent in the media, newspapers everywhere, the impact would have been negligible, almost zero impact, negligible impact on your books. Most important thing, which is called the LIBOR transition. I don't know how many companies in emerging market. Now, please note that I'm using the word emerging market. I don't know how many companies in emerging market who already shifted to SOFR, which is secured overnight financing rate, because there is no data pertaining to that in the public. And when you do not have a data, you cannot comment on anything. But having said that, slowly and steadily in the newspapers, in the business world, I am finding that the fresh issuances which are going in emerging market, it is on SOFR, which is secure overnight financing rate, which means transition matrix, which means the person will shift from dollar denominated asset or dollar denominated liabilities, which based on LIBOR, London Interbank Offered Rate, now it will shift to SOFR. which is secured overnight financing rate, probably ESTR, Euro short-term rate, maybe ONIA, Australia overnight index average, maybe SONIA selling overnight index average, or maybe any other index. Henceforth, the impact of that transition would definitely come in P&L. And let me study for you. An entity shall apply below paragraphs to a financial asset or liability. Please take a note. If and if only if the basis of determining the contractual cash flows of the financial asset or financial liability changes as a result of interest rate benchmark reform. Interest rate benchmark reform, which means LIBOR to SOFR, ESTR, ONIA, SONIA, and there are many. It means INDA is also acknowledging that. Now, I link dollar volatility with accounting with hedging concepts.